Hi, this is Nate Williams, back again with PFG's Doctor Tax Guide, a guide to tax strategy for the dental practice owner or medical practice owner, or really any business owner who wants to understand better how taxes work and how to structure your financial life. Today, we're going to be going over part two of this video series, which is the business entity. This is going to be very fun and exciting. Let's jump right into it. The first thing I want to discuss is the optimal business structure, the optimal banking structure to set up and establish for your business. So you've got your business accounts separate from your personal accounts, right? With your business, we want you to have one business checking account and one business credit card. You could operate $1 billion dental practice with one checking account and one credit card. Now, if you say, well, I want to get multiple credit cards to give them to multiple people in my business, my office manager, my other assistant who does all the supply ordering, my spouse, that's fine. You're going to have one business credit card account. And with that one account, you can have multiple card users and multiple card holders, but there's only one account to manage and control. We want to keep things as simple as possible. Remember, to quote a very wise man, Leonardo da Vinci, simplicity is the ultimate sophistication. Wow, what a powerful statement. If you own your building and you have a separate real estate LLC, you will have one checking account for the real estate LLC, and that's it. And then for your personal accounts, we want you to have one personal checking account, one personal credit card, and one high yield savings account, like at Capital One or Marcus.com. So this is the optimal business banking structure. You get the pattern? One business checking account, one real estate checking account, one personal checking account, one business checking credit card, one personal credit card, not multiple. That's just complication and catastrophe waiting to happen. When you own your building, this is how you're going to structure the payments on building related things and the payment between the dental practice and the real estate LLC. If you don't own your building, you can skip to the next part. But if you own your dental practice, all the collections are going to go into the dental practice checking account, and the dental practice will pay all business expenses such as real estate taxes, maintenance, repairs, pest control, snow removal. If the parking lot needs to get refinished, the dental practice will pay for that. If the HVAC system goes out, dental practice pays for that. If the roof is leaking and you need an entirely new roof, the dental practice will pay for that. The dental practice will also make one rent payment per month, set up on auto pay, of course, into the real estate LLC. The real estate LLC will then pay the mortgage, if any, to the bank. So the real estate LLC checking account has only two transactions per month. One, the rent coming in, set up on auto pay. Two, the mortgage payment to the bank, set up on auto pay. Other than that, the real estate checking account does nothing. Okay? That's very important for several reasons that I won't get into. Right now, just follow this structure. The next section I want to talk about, next topic is which business entity should you choose? Well, most doctors own their business through an LLC or a PLLC in states that have a PLLC. Now, a PLLC just stands for Professional Limited Liability Company. The P sounds really cool, professional, doesn't it? That's the only difference, is the cool sounding P. An LLC and a PLLC are the exact same thing. Most of the time, this entity elects to be taxed as an S corporation. An LLC or PLLC is what's referred to as a disregarded entity for tax purposes. The LLC doesn't have any tax effect in and of itself. You create the LLC, and then you choose how you want the LLC to be taxed, either as a sole proprietor or as an S corporation, or if there are multiple members or owners, as a partnership. Again, most doctors, LLC elected to be taxed as an S corporation. The important thing is this: the entity provides legal liability protection. That's the reason you have an entity, to provide legal liability protection. One important way to guard this legal liability protection is to use your business appropriately, which means to not commingle funds. Okay? In other words, the business pays for business expenses. Personal pays for personal expenses. The business pays business debts, and you personally pay personal debts. The business does not buy your groceries. The business does not pay off your personal credit card. The business does not pay your home mortgage. And from your personal checking account or credit card, you do not pay business expenses. Out of your personal account, you don't pay a supply bill. You keep them separate. Business pays business, personal pays personal. That's a very important distinction. Now, I would like to talk about how an S corporation saves you money in taxes. Here's the catch: an S corp potentially can save you in payroll taxes, aka Social Security and Medicare tax. An S corp does not save income taxes. Let me restate that. An S corp saves Social Security and Medicare tax, aka payroll taxes. It does not save income taxes. Let me explain and show you how this works. So you've got two doctors here who are identical in every way, except one of them operates as a sole proprietor, which is reported on Schedule C of the tax return, the personal tax return. Dr. 2 operates an S corporation. Okay, they both own an LLC, right? So this is sole proprietor LLC, S corp LLC. The business gross income is $300,000 in both cases. The sole proprietor, that $300,000 drops right to the business net income. The S corp, however, the doctor pays him or herself a salary. That doctor's salary is deducted from the business gross income to give the business net income. So in this scenario, the doctor has $300,000 of income, pays himself a $100,000 salary, so the business net income is $200,000. Now let's look at their personal income. The doctor's salary for the sole proprietor is zero. There is no salary. Whereas the doctor's salary for the S corp owner is $100,000. The business income for the sole proprietor is the total income for the business, or $300,000. The business income for the S corp owner is only $200,000. But the total personal income, subject to income tax, is $300,000 under both scenarios. So the total income tax paid, assuming a 25% average or effective tax rate, is $75,000 under both scenarios. Here's the catch. This sole proprietor is going to pay Social Security and Medicare tax, aka payroll taxes, aka FICA taxes, aka self-employment taxes. They're all different ways of saying the same thing: Social Security and Medicare, paying into those wonderful government systems. This doctor is going to pay the Social Security and Medicare tax on the full $300,000 of income, and is going to have a Social Security and Medicare tax bill of $29,438. And so the total taxes paid is $104,438. This doctor, who has the S corp, is only going to pay Social Security and Medicare tax on the salary portion. So at a salary of $100,000, the Social Security and Medicare tax would be $15,300 for a total tax of $90,300. So this doctor, right off the bat, saved $14,138 by having an S corporation. That's how the S corp saved taxes. saved that much, and it was on the Social Security and Medicare. The next question I want to address is, how do I get money out of my S Corp? There are two ways to get money out of your S Corp. First, you get a paycheck like everyone else. In the previous slide, I showed how with an S Corp, you have you set a salary for yourself, and you get that salary as a paycheck. The second way you get money out of the S Corp is to take a distribution of profits called a draw. This is simply where you transfer money from your business checking account into your personal checking account. Now, you can transfer this using an automatic wire transfer from your bank, or you could write yourself a check. That would be the more cumbersome way to do it. But you transfer money from the business checking account into your personal checking account. Now, this is important. Your PFG advisor will work with you to help you structure both your salary and how much you're taking out as a draw. I'll talk about what you don't want to do in a minute. Here's another very important thing. To get money out of the business, you don't pay off your personal credit card with your business checking account. You don't make your home mortgage payment from your business checking account. That is not how you get money out of the business. You transfer it in the form of a draw, and then from your personal account, you pay personal expenses. Another way to think of this draw is a dividend from the business, okay? It's similar in concept. It's not a dividend, very technically speaking, but it's similar in concept. So here's a warning. I said that you can take a distribution from your practice called a draw. We caution strongly against treating your business like an ATM, pulling money whenever you want for whatever reason you want. This is a bad habit for many reasons. Treating your practice like an ATM and just getting addicted to pulling money out whenever you want is similar to trying to lose weight or be fit, but eating cookies whenever you want, right? The two things don't go hand in hand. Financial fitness and treating your business like an ATM, they don't coexist. Another question you're going to ask on managing your business entity is, how do I get a tax deduction? So let me emphasize this with regard to what a tax deduction is. To be tax deductible, an expense needs to be both necessary and ordinary to the business. I'll talk more about this later. But to get a tax deduction logistically, what you do as a PFG client is very simple. First, when you're making the purchase, you determine, is this a business expense or a personal expense? If it's a business expense, pay for it from your business credit card or checking account. If it's a personal expense, use your business or checking or credit card. We will take care of the rest. So again, very simple. In your wallet, you should have 2 credit cards or 2 debit cards, your business credit card and your personal credit card. When I go to make a purchase, you decide, is this business or personal? If business, swipe the business card. If personal, swipe the personal card. Once you pay for it from the business card or business checking account, again, we will take care of the rest. Now, warning, don't pay for personal expenses from your business accounts. I've already mentioned this several times. Just because you swipe your business credit card, that does not make this thing a business expense and therefore tax deductible. It's the nature of the expense that makes it deductible. So you need to use some judgment here, and this is very important. Anyways, these are a few keys, few important things on the business entity, how to structure the business entity, and how to manage it for taxes. Talk to you next time. Thanks.